Two friends, same income, same savings, completely different investment strategies. 20 years later, one of them is sitting on wealth that makes the other physically sick when they see the numbers. But here's the twist. The one who lost isn't who you think. My name is Sam, and today we're running the full 20-year simulation on the biggest investment debate of our generation: real estate versus index funds. Not with cherry-picked examples, not with best-case scenarios, with every hidden cost, every hour worked, every tax implication, and every midnight emergency included. If you've been paralyzed trying to decide between buying rental property or investing in the market, if you're tired of half-truth comparisons that conveniently ignore inconvenient data, if you want to see what compounding actually looks like when you include reality, stay with me. Subscribe if you want investment breakdowns that show the whole picture, not just the pretty parts. Drop a like if you're ready for math that might make you rethink everything. Here's our setup. Two people in their early 30s, both sitting on $65,000 in savings, both pulling in $72,000 annually at their day jobs. We'll call them David and Elena. David decides real estate is his path to wealth. He's watched the YouTube videos. He's read Rich Dad, Poor Dad 3 times. He knows rental income is passive income, and leverage is how the wealthy get wealthier. He finds a single-family home listed at $320,000, puts down 20%, $64,000, locks in a mortgage at 6.8% for 30 years. Monthly payment comes to $1,685. Property taxes, $1,800 annually. Insurance, $1,400 a year. He lists it for $2,200 a month and gets a tenant within 2 weeks. On a napkin, David's making over $500 a month. He tells his family he's a real estate investor now. Elena takes a different approach. She opens a brokerage account, dumps the $65,000 into a broad market index fund tracking the S&P 500, sets up automatic monthly investments of $450. Then she forgets about it. Her friends ask what she's doing with her money. She says, investing. They ask in what? She says, stocks. The conversation dies. No property to show off, no tenant paying her mortgage, just a login and a number that goes up and down. Year 1 feels wildly different for both of them. David collects $26,400 in rent. After mortgage, taxes, insurance, he's pocketed about $4,800 before any maintenance or repairs. He drives past his property twice a week just to look at it. It's real, tangible. He owns something. Elena's account grows from $65,000 to around $73,000 by year's end, with contributions and market returns. She checks it maybe twice. Feels like nothing's happening. Socially, David's winning. He's got the story, the asset, the hustle. Elena's just waiting. But let's look at what David's not saying at dinner parties. Month 3, the HVAC system makes a grinding noise. Repair guy says the compressor's going $3,200. David doesn't have $3,200 liquid. He puts it on a credit card, plans to pay it off with next month's rent. Month 7, tenant's lease is up. They move out. Unit sits empty for 6 weeks while David cleans, repaints, and finds someone new. Loses $9,600 in rent during vacancy. Spends $1,400 on turnover costs. Month 9, water heater dies. $1,800 to replace. Year 1 actual profit after all real expenses, maybe $1,100. Not the nearly $6,000 he calculated on paper. Pattern interrupt. Show expense breakdown. Projected annual profit versus actual profit after HVAC repair, vacancy, water heater, and turnover costs. Elena spent 0 hours managing anything. Her $73,000 required no phone calls, no weekends lost, no emergency credit card charges. But David still has something Elena doesn't: leverage. He controls a $320,000 asset with $64,000 of his own money. That's 5-to-1 leverage. When that property appreciates, he's making returns on the bank's money, not just his own. Year 3, David's property has appreciated maybe 3% annually. It's now worth roughly $340,000. His equity, what he actually owns after subtracting what he owes, has grown to about $95,000. His mortgage balance has only dropped by $11,000 or so because early payments are mostly interest. But the appreciation added $20,000 in equity he didn't have to work for. That's the magic of real estate. Other people's money working for you. Elena's account, with consistent contributions and average market returns around 9%, is sitting at about $108,000. She put in $65,000 initially, plus $16,200 in contributions over 3 years. The rest is compound growth, still neck and neck. But the experience couldn't be more different. David has replaced a fence, dealt with a tenant who paid late twice, handled a noise complaint from neighbors, and spent roughly 12 hours a month on property management tasks he doesn't pay himself for. Elena has spent 0 hours, logged in 4 times total, each time for less than 2 minutes. Year 5 is where the numbers start separating in unexpected ways. David's property is now worth about $360,000. His equity is around $120,000. He's raised rent to $2,400 a month to keep up with market rates. But his property taxes went up. Insurance doubled after a hailstorm damaged roofs across the neighborhood. Even though his was fine, he's replaced the garage door for $2,800 and dealt with a foundation crack that cost $4,900 to fix. His actual cash-on-cash return, the money he's pocketed relative to what he invested, is hovering around 4% annually after all real costs. Not bad. Not the 15% he tells people, but not bad. Elena's portfolio has grown to about $162,000. Original, $65,000 plus $27,000 in contributions. The other $70,000 is pure market appreciation. She's never touched it, never sold anything, never timed anything. Just automatic deposits and compounding. Pattern, interrupt. Show growth curves. Real estate equity growth, steady but linear. Stock portfolio growth, exponential curve starting to bend upward. Year 10 is where most people quit comparing because the data gets uncomfortable for whichever side they chose. David's property is worth approximately $460,000. His remaining mortgage is $193,000. Equity, $267,000. Over 10 years, he's poured about $48,000 into the property beyond the original down payment. Repairs, vacancy, maintenance, capital expenditures, all real costs. Total invested, $112,000. Current equity, $267,000. Net gain, $155,000. Not bad at all, especially considering someone else paid most of the mortgage. Elena's portfolio is sitting at about $348,000. She invested $65,000 up front plus $54,000 in contributions over 10 years. Total invested, $119,000. The other $229,000 is compound growth. She still hasn't managed a single tenant, fixed a single toilet, or lost a single weekend to property showings. They're in the same ballpark. David, slightly ahead on paper if you don't count his time. Elena, slightly ahead if you do. But the real separation happens in the back half, years 10 through 20. This is where compounding goes from interesting to absurd. Year 15. David's property is worth roughly $550,000. Mortgage balance down to $135,000. Equity, $415,000. He's collected rent for 15 years. After every real expense, mortgage interest, taxes, insurance, repairs, vacancy, capital expenditures, his total net cash flow is probably $60,000 to $90,000 above costs. Add that to equity, and he's sitting on about $475,000 to $505,000 in total wealth from this investment. Respectable, real, built through discipline and leverage. Elena's portfolio at year 15, roughly $635,000. She invested $100,000 total over 15 years. The other $535,000 is compound growth, She's now ahead by over 125,000, and she never fixed a roof. Year 20. The finish line. David's property is worth approximately 675,000. His mortgage is nearly paid off, maybe 30,000 remaining. Equity, 645,000. His total cash flow over 20 years, after every possible expense, is probably 100 to 140,000. Total wealth created, around 760 to 785,000. He spent an estimated 2,000 hours over 20 years managing this property. That's about 2 hours a week on average. Showings, maintenance calls, tenant screening, coordinating repairs. If you valued his time at even $30 an hour, that's 60,000 in unpaid labor. Adjust for that, and his real return drops. But still, 760,000 from a 64,000 initial investment is extraordinary. Elena's portfolio at year 20, approximately 1.1 million. She invested 65,000 initially, plus 108,000 in contributions over 20 years. Total, 173,000 invested. The other 927,000 is pure compounding. She spent 0 hours managing it, 0 emergency calls, 0 tenant drama, 0 risk of a single bad tenant destroying a year's profit. Pattern interrupt. Show final comparison table. David's real estate, 785K total, 2,000 hours invested, 4 to 5% average annual return. Elena's index funds, 1.1 millions total, 0 hours, 9% average annual return. Elena is ahead by roughly 315,000, and she did it by doing nothing. Now, before the real estate crowd loses their minds, let me show you where David actually wins. Tax advantages. David wrote off mortgage interest, property taxes, and depreciation for 20 years. That saved him probably 8 to 12,000 in taxes annually. Over 20 years, call it 160 to 240,000 in tax savings. Add that back, and his net position is much closer to Elena's cash flow. Elena's index funds don't send her a check every month. David's property did, even if it was smaller than expected after expenses. For someone who needs monthly income, real estate delivers in a way stocks don't. Until you start selling, leverage. David controlled a $675,000 asset with $64,000 down. That's 10 to 1 growth on his initial capital. Elena controlled exactly what she put in. No multiplier effect from borrowing. But here's what the real estate side doesn't tell you. Concentration risk. David had one property in one neighborhood in one city. If that area declined, his entire investment declined. Elena owned pieces of thousands of companies across every sector and geography. Diversification is built-in liquidity. If David needed money fast, selling real estate takes months and costs 6% in agent fees. Elena could liquidate her entire position in 2 clicks and have cash in 3 days. Volatility versus stability. Elena's account dropped 35% in 2020, then recovered and kept climbing. David's property value stayed relatively stable, but his stress level spiked every time a tenant moved out or something broke. Different risk profiles, different psychological costs. So who actually won? If you measure purely by wealth created per hour invested, Elena crushed it. 1.1 million with 0 time input destroys 785,000 with 2,000 hours of work. If you measure by tax efficiency and leverage, David's returns look better once you add back tax savings. If you measure by monthly cash flow and tangible assets, David had something you could see and spend. If you measure by stress and simplicity, Elena slept better for 20 years. The truth is, both strategies work, but they work for different people in different situations with different goals. Real estate wins if you're willing to treat it like a business, if you enjoy the tangible nature of property, if you're in a market with strong rent-to-price ratios, If you understand tax strategy and can leverage properly, index funds win if you value time over everything. If you want true diversification, if you can psychologically handle volatility, if you just want to set it and forget it, the real trap isn't choosing real estate or stocks. The real trap is choosing either one based on a YouTube thumbnail or something your cousin said without running the actual numbers for your situation. Most people should probably do both. Some real estate for cash flow and tax advantages, some index funds for growth and diversification. But if you can only pick one, the question isn't which investment is better. The question is which fits your life, your time, your risk tolerance, and your actual goals. Because the best investment isn't the one with the highest return on paper. It's the one you'll actually stick with for 20 years. If this changed how you think about real estate versus stocks, subscribe. I break down investment strategies with the full math, not just the highlights. Next video is about why your 401k is designed to keep you working until 65 and what to do about it. You're not going to want to miss that. I'll see you there.